mode.
Good evening, everyone. Welcome to a webinar from Admiral Markets. My name is Chris, and together with Nana Tarantula FX, we're going to take a look at trading with pattern hunting in the Forex market. So focusing on patterns, pattern recognition, and what are patterns, etc. All of that we're going to dive into in this webinar in the next hour. So before we do that, though, as always, the fact that the webinar is intended for a global audience, it may not be suitable for everyone. Therefore, take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to see if it is suitable for you, and perhaps other details and conditions. And also the fact that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, good evening, Caitlin and Lazaro. I hope that my sound is good. If there's any issues, just let me know. Alrighty, so regarding Admiral Markets is hosting this webinar. So once the webinar is finished, take a look at admiralmarkets.com for more content, analysis, and also information about the MT4 Supreme Edition that has 50 plus extra features, which basically made one of the things that made Admiral Markets win the UK Broker Award this year. Alrighty, so today's focus is patterns, and I love patterns. I'm a big fan of spotting patterns, but there are really a lot of different types of patterns. If you think about patterns in general, maybe the first pattern you think about is chart patterns, maybe you think about candlestick patterns. Those are definitely two of the most famous ones, very good ones, but there are actually a lot of different patterns, and we'll dive into all of them. Well, not in every detail, because there's so many that probably the webinar would have to be split in, I don't know, 12 parts or something like that. But we're going to go through and discuss how to spot patterns, etc. So first of all, what is a pattern? I mean, how does it belong into the charting kind of picture? How can we use patterns to do technical analysis? And within technical analysis, I guess you can look at it 1,001 ways, but in my opinion, I always kind of split it in a couple of different groups. I look at support and resistance. I look at trend. Is it ranging? Is the market a reversal? I look at, is there momentum or is there a correction going on? And I look at patterns. So for me, these are kind of the legs at how I look at the market. And then, well, it really depends from moment to moment, or sometimes I use a fib for support or resistance. I'm a discretionary trader. I obviously do have a certain set of things I use. For instance, for support or resistance, I don't use parabolic, although I'm not saying it's nothing wrong with it. I don't use Ichimoku, but that could be a very good way as well. There's a lot of echo. Alrighty, let me change that. Let's see. Let me know if this is a bit better. I put it a bit closer. So, there's a lot of ways of doing support and resistance. I have my way, but there are many 1,001 ways, and they could be equally good, right? So, but these are the four legs I look at. So patterns, basically, what is a pattern? Well, it's basically something that repeats in a predictable manner, and we see patterns really across the board. We see patterns in a lot of different fields, ranging from, as I already mentioned here in the second row, geometric, science, math, languages, visual patterns, and even natural patterns like waves and all kind of things that we see in nature, like music, perhaps even we see repetitive patterns. So it's not so uncommon. We see it in weather as well. We see weather patterns that repeat, etc. You get my point. So the market and price has those patterns too, and we can observe them, find them, use them, capitalize on them, etc. Now, with the market and price, patterns sometimes are disputed perhaps by some traders or some non-traders, but it's really a bit strange that it is disputed because these patterns really happen everywhere. We got economic patterns, financial patterns, patterns are everywhere. All experts, all people from those particular fields use patterns to make conclusions from the past about the potential of the future. That's everything and all. Everyone does that. Everyone uses those patterns to make the potential estimate. So why not market and price? I don't see any difference. So what I do as a rule of thumb is that basically if something happens twice, I see it as a potential pattern. And if it happens a third time, it's actually the pattern confirmation. So let's say that price hits a 21 EMA on its way down in this, for instance, in this screenshot, right? Then the third time would be the confirmation, and that would be the pattern, seal, or how do you say it, the extra kind of confirmation that says this is a pattern. Anything that happens 3 times or more is basically the point that it's not becoming coincidence. Now, of course, the more times this happens, the more that the pattern is confirmed, the more robust or stronger the pattern is. But then the 3-time rule is the minimum. So what kind of patterns do we have? Well, we have price action patterns, candlestick patterns, chart patterns. Price action basically in the sense like we got price moving quickly then slowly. It could be seen as price action as a certain movement of the candle where we have a big bullish candle. Maybe that's a candlestick pattern in fact, but it's okay. Depends how you look at it. Candlestick patterns obviously are very well known. It's a certain set of combination of candles or candle that occur on the chart. And chart patterns also, head and shoulders, bear flags, things that look like this, where you have price moving, for instance. Oh, I don't have my drawing tool open. Sorry about that. Is the sound a bit better now that the microphone is closer, by the way? Chart patterns like this, for instance, right? This is a bull flag, and it's not my goal in this, my part. I'm not sure what none of this is going to present, but to talk about all chart patterns at the moment. But I just want to, give you an example. This is a bull flag. Maybe Nana's going to dive into those, but those are very famous with a lot of different styles of patterns. Right? That's just one example. But we also have different patterns, timing patterns. I talk about that a lot in the live webinars, where, for instance, I talk about the fact that if 5 candles don't break the bottom or top, that the correction or reversal is more likely. That's a timing pattern. I talk about the fact that if a 21 EMA is not hit, let's say anything between 5 and 10 times, then that is something that increases the momentum. Momentum is strong if price stays below the 21 EMA, 5 to 10 candles, that doesn't touch the 21 EMA, right? Well, then that's a pattern, right? A timing pattern, in my opinion. There are time of day patterns, like the pound that has a volatility outburst when the London session opens. There are weekly patterns where Monday and Friday are different types of trading days than Tuesday, Wednesday, Thursday. So those are timing kind of patterns, or time of something patterns, like day, week, etc. We got currency pair and currency specific patterns or pair specific patterns. Euro pound is a slow mover. That's a pattern, right? The pound yen is a big mover on average. That's also in a way a pattern. The dollar is the dominating factor in the Forex market. It really sets the course for the direction, for the general market. That's a pattern, and wasn't always like that. Now it is. 100 years ago, it would have been the pound probably, right? So that's a very long pattern. So you got these types of things as well to think about. We have general visual patterns. Anything that we can see on the chart that repeats is a pattern. We got market behavior patterns, which is, for instance, Elliott wave patterns, right? We got wave structures. Market structure, the fact that even market trends or the market respects support and resistance is in fact also a pattern. If it does so at a certain level, if the 150 is respected, I group it together with support and resistance, but if that happens enough times, it's actually in a way a pattern to a certain degree as well. We have the fact that market makes breaks and bounces. That's a repetitive pattern of the market. It makes pullbacks and continuations. That's a repetitive pattern as well. It reacts to Fibonacci, trend lines, moving averages. Those are all different types of patterns we can find around those tools. Patterns around tools, in fact. And we got intermarket correlation patterns, where basically if gold goes down, Aussie follows, or if Aussie goes down, gold follows, right? Or if China has data that does this, the Aussie reacts in this way, right? Or bonds do that, stocks do that. Those are also types of patterns, right? S&P goes up, dollar goes down. I'm just making it up right now. I'm just don't listen to these, but you get the point. There are correlations there. So the start and the end of the patterns. Basically, eventually we have a pattern start, and it continues for however long it wants to, and then eventually it breaks down. And that's just a cycle of a pattern and a development. And that typically can last, that will happen, it will last, it could last various levels of time. Some patterns can be very long, some patterns can be very short, some can be in the middle. The length of the cycle, we don't know. For instance, the commodity upside, it was a bullish pattern, in fact, or maybe a bullish trend, but okay. Maybe a wrong example. But in any case, patterns like, for instance, the fact that the euro dollar is, no, maybe not a good example. Can't think of it now anyhow. Let me go back to the previous slide. Let's see. Let's say Fibonacci, for instance, or a moving average. If you see price reacting to a moving average in the last week a couple of times, and you use it again, and you use it again, and you use it again, eventually, of course, that pattern is going to break down because price is not going to use that moving average at one point. That's what I mean. So the market is a repetition from the past, but we have to realize that each situation will be unique. Just because something happened in the past, it could repeat again like it has the last few times, like it has the last 4, 5, 6, 7, 8 times. But eventually, at one point, when we're looking at the market now, it doesn't mean that it has to repeat again. There's no guarantee we will ever get that repetition. It could, doesn't have to. Each situation, each market situation is unique. We do have patterns in the past, and there is a chance that they can repeat in the future, but it doesn't mean they have to. So we can use those patterns from the past, but what I do is still analyze what's going on now. I analyze using support and resistance, using trends, using patterns to make that judgment. So it depends, how we use those patterns, also on how we trade. Are you a discretionary trader or a non-discretionary trader? That will depend. If you are a discretionary trader, you can use those patterns, try to find new patterns, try to use old patterns, and you'll be using it in combination with other elements of the chart to see if it's worth trading that pattern. So you'll make a case-by-case call, yes, no, yes, no. So there's less emphasis really on the data, like this particular pattern works 50, 60, 70% of the time, because you're using it in a discretionary method. If you're using it non-discretionary, you're basically going to keep using that pattern. Doesn't matter if there are other factors that might say that the pattern is less strong, because you're just using an edge that's very based on data from the past, and that's it. And you're going to keep playing that edge. All right. So that's basically a non-discretionary method. Does anyone have any audio issues? Do you hear me? I have one audience member that says no audio. Okay. Great. One second, folks. Alrighty. So, yeah, if you use that, then the thing is you will have to monitor your system, your automated system probably, very closely and see if there's any breakdown of that pattern, which means that if you see you would have a certain expectation, and if those statistics are not coming through, you might need to switch and go away from that pattern. You can still keep trading it on a demo and see if that pattern comes back. Let's say you're trading an automated system with a 70% win rate, and you got a couple of months drawdown. You're seeing statistics that have never been seen before. Those could be signals that you might need to scale down the risk, go to a demo, stop with that particular pattern. Maybe that pattern has stopped for whatever reason, a breakdown has occurred. Might need to switch to demo. You could still shadow trade it on the demo to see if it gets back to its original level. You can switch it back live again. So that's how you could tackle that, for instance, with the non-discretionary method. All right, so spotting patterns. Basically, we could then hunt for a pattern, try to find it, confirm it, backtest it, consider it if there are any changes compared to now, or are there any fundamental changes, any particular things that occurred at that point that explain a pattern at that time, but maybe not now. The why of the pattern, why is that pattern occurring? Is there any sensible logic behind it? Because we could find a lot of patterns perhaps that are really just coincidence or are just random noise. So it's good to look for patterns, find patterns, but thinking about why is that pattern there? Is there a particular reason for that pattern that I can explain to someone in a couple of sentences is important as well. And then analyze now what's going on now in the current market, and do you think that pattern can continue? I mean, this doesn't have to be an analysis that takes 2 weeks, of course, but some type of investigation. And then important as well with the pattern, what is your confirmation point? What is your validation point? There is a pattern in play. You have found a pattern. It looks good. You have a reason for it. You tested it. It seems to be a strong pattern that has occurred over the last period of time. The next part then, if you trade it or test it, is to have a moment where you say, okay, at this point, the pattern plays out indeed as I expected. At this point, it doesn't. So we have our boundaries set. Now, the cycle of a pattern, basically, at one point, there's going to be a trigger for a new market environment. Let's say we have, from a big point of view, we have this pattern of the quantitative easing in the developed world in a way, right? With the US and Japan and then Europe having a lot of quantitative easing. That is kind of a pattern in the meantime. It really was not something that occurred before the financial crisis of 2008, where the fiscal policies did the monetary policy, excuse me, had its ups and downs, but never had such a loosening. That is, in a way, a trigger for a new market environment, I would say, right? In my humble opinion. So, there's always something that triggers kind of a new kind of environment, a new situation. And in that new bubble, in a way, there will be smaller patterns that play over. So you get different types of patterns or different types of time scales and different types of environments and methods that repeat, are created, repeat, and stop. All right, so that's basically how the cycle is. We see it repeat. It's eventually we see it. Some people see it. Others see it. It becomes visible. It offers opportunities, and then eventually the market changes and the pattern breaks down. So when I'm looking for patterns, pattern hunting, it's basically a bit of a creative approach. In fact, I like it. It's fun. It's it gives you the ultimate freedom here just to look at data, at charts, anything you like, in fact, because ultimately this is something that should be fun. If it's not fun, then find something that is fun. I mean, if you're a numbers cruncher that loves to look at a lot of fundamental data and reports and look at the big picture perhaps, then that's maybe where you want to find patterns. If you look like looking at charts, then maybe you want to focus on technical patterns. So it really depends, but it's supposed to be creative and fun, and you can really just go to a chart, find anything you want to focus on and start looking for patterns by going back into the past. And it's a very good learning experience because the more charting time, and it talks about it too a lot, more charting time we got under our belt, the more we recognize patterns, the easier we see patterns, and we just become more fluent in the language of charting and data, just like any language for that matter. So it's a fun thing. So multiple patterns in play basically means confluence. So if there are multiple patterns, well, the odds are getting stacked in our favor. That's great. And you could even combine, of course, patterns as well from technical and fundamental elements. Now, here you see a screenshot actually below, and one of the patterns that I look for instance, is moving averages. There are a lot of patterns that occur around moving averages, in fact, because especially with the Forex market, price is pulled back to moving averages and price expands away from moving averages. And moving averages explain kind of that corrective momentum type of environments that we so often see, or always see, in fact, it's one or the other. And you can find a lot of patterns with moving averages, in my opinion. So I found it quite interesting to use moving averages and to do testing with moving averages as well, and to find more angles and new ways of using them. So that's one of my favorites. I'm a big fan of Fibonacci. I'm a big fan of waves as well. So as you can see, I use patterns a lot. I use chart patterns. I use candlestick patterns. So yeah, I am a big pattern fan, I guess. So I got a couple of minutes left, so we can dive into some live charts. And maybe let me put on this template. And does anyone have a particular moving average in mind? Because I want to use one that I don't use. So we can look together at the chart, or any other tool or indicator. Does anyone have a preference? 13. Okay, that was the first one. And an LWMA is also suggested. And you know, pattern hunting doesn't have to be that complicated. You can use just one single indicator and try to find patterns with that. Obviously, I don't think that the market is that simple that I would think that still looking at the overall multiple time frames and looking at trend and support or resistance is still very useful. But just having one indicator already on the chart could give already a lot of inspiration for good doses of creativity when looking at opportunities. That's my point. So even just a simple 13 EMA could get that, right? Maybe we can let's take a look at the 30-minute chart. I don't know, just a random choice. So we don't go back like months and months. That's the only reason. So for instance, let's scroll back and see if we can detect anything. Look with me. If you find anything, give a shout if you see anything that's interesting. And of course, one indicator, one EMA offers less perhaps combinations than if we add an AO, which we have at the bottom. So we can keep that in mind too, for instance. I had nothing prepared, so I'm really looking live with you if there's anything that catches our attention. But perhaps something as simple as a candle close at the very first time that the 13 EMA switches angle. Now, obviously, you're going to have problems when it does that a couple of times in a row. Like here, for instance. Right? So it's a pattern that is probably very, not even that bad. It looks nice. So it's a trigger that could be already very useful, but it's obviously something that is not something that can be so simple that we always trade if the EMA closes on a different side. But it generally speaking doesn't do bad. So we can see that there's a particular edge, perhaps, if we are able to use it in combination with the trend, support and resistance, perhaps, right? So that could be something worth considering, especially probably trading with the trend. If we can discover a trend, maybe we can zoom out here a bit more. Could be good to have a second time frame, like a 4-hour chart, and say, okay, this trend is down or up, for instance. And let's go here. Trend in the meantime is down at that point on a 4-hour chart. In the meantime, and we got a lot of downside before that already, as you can see. And if we're looking for a full candle, for instance, a full candle close with a candle close that is clearly going through this 13 EMA, like this one, and a candle close near the bottom with an angle downside, that could be a trigger, for instance, right? So this is something we can test and see how many times does it work out. Just a very simple test. And it's maybe a pattern that is not too bad just like that. I don't think it's going to be profitable if we only use that, though. I doubt that. But if we find and isolate the situations that we have no support or resistance nearby, strong support or resistance like a daily top or bottom, for instance, or a weekly top or bottom, and we have a trend going on, then that might not be bad at all. Right? So that's just a really, I didn't prepare it. I just wanted to freewheel together with you. But that, those are things that we could use. Let me add one more EMA. Hang on, folks. And then Nena's going to take over soon, because I see that actually, in the meantime, the I don't know which number. This is a special indicator, so I'm not sure what the LMW is. LWMA is here, but let's see. All right, let's add one long term quickly, and here, for instance. Well, I think we have a bit too little time. Anyhow, if you get my point, you can always add again a different kind of pattern if you change the parameters that you're looking at. But this is the whole idea. It's just that you can freewheel on the charts, go back, and try to find a few patterns. I mean, the idea is that if you're a discretionary trader, that you use it with discretion anyhow. If you're a non-discretionary trader, then you really want to thoroughly test it as if it's an automated system, because otherwise you can get into trouble. If you're using it at discretion, if you're using it as one of the many things to find confluence, then you can do a bit of testing, but it doesn't have to be that serious, because it's all still about what's happening now and how do you analyze the structure of the market now. So it depends. So, all right, that's my 2 cents. I'm going to pass it over to Nena now.
Thank you, Chris. So we are going to continue with webinar. I'll show you actual chart patterns, and then we will try to find those on live chart, okay? So actual chart patterns and live hunting, that is what we are going to do. So I will cut it to the chase and show you basic and advanced chart patterns. So basic chart patterns are symmetrical triangles, flat top triangles, flat bottom triangles, rectangles, flags, pennants, head and shoulders, and inverted head and shoulders. Okay. Non-standard special patterns are hook reversal pattern, cup and handle, ascending scallop, running triangle, diving board, also called V-shaped reversal, and a rooftop. Okay, so these are patterns which are commonly found in the Forex market. And as Chris has explained, we are using the patterns along with confluence points. So some of those confluence points can be EMA, can be EMA crosses, can be pivot points, candlestick patterns. All of those can be applied with basic and advanced chart patterns. Someone has asked, Caroline has asked about 35 low weighted moving average. So LWMA is low weighted moving average. It is okay. I have applied a couple of times a low weighted moving average on my charts, and I have noticed that low weighted moving average is also good for spotting price resistance, price support, and actually giving, in some systems, LWMA is used for picking the entries. But we will not talk about it now. We will cover M and W, we will cover all these patterns. Yes, Carolyn is saying M and inverted M. It's M and W. So yes, I will show them also. Those are basically, those are chart patterns. But I thought that we should basically put emphasis on others which probably traders do not know of. Yes, there are 2 more chart patterns. Those are W, that is very bullish, and M is bearish. But the thing is, some traders tend to not look at these patterns. So at this time, we will concentrate on those basic and advanced. Okay, triple bottom, double bottom, those are not actual chart patterns. Those are more like candlestick patterns, okay? Because when you see triple top, it's actually something like this, right? So it's a chart pattern, but it's a candlestick pattern, same as double bottom, triple bottom, quadruple bottom. You can have as many bottoms as there are touches of price wicks. So we will not cover those. Those are not these kind of chart patterns. So we will be talking about connecting triangles, flat top, flat bottom, rectangles, flags, pennants, head and shoulders, inverted head and shoulders, hook, reversal, cup and handle, ascending, scallop, and all those. Okay. Okay, this is first example of symmetrical triangle, and when you see symmetrical triangle that has basically some form of a flag, this can be also counted as a pennant. Okay, so this is a pennant, right? So this is a flag, this is a flag, this is a flag pole, and the height, the actual height of flag pole is added to the breakout part of this pennant, and that is the actual target. So when you see this, you can treat it as a symmetrical triangle, but also if you see this one, this can be treated easily as a pennant, bearish pennant. Okay, so this is actually a bearish pennant, and when you spot this, you just need to take a break of it, either with three ways how to trade breakouts. You know of it, we already talked about it. Those are trigger happy trades, those are breakout retest, and breakout pullback continuation trades. Okay, Carolyn is saying about three Buddha tops and bottoms. Actually, those are a form of inverted head and shoulders, and it's a lot easier to tell inverted head and shoulders because a lot of traders simply do not understand what is three Buddha top and three Buddha bottom. So actually, three Buddha top and three Buddha bottom is inverted head and shoulders variant. Okay. This is also a form of symmetrical triangle, but also because you can see this pole here, this is actually a pennant also. And adding to that, you can see M pattern, which is basically a breakout point of this pattern. So this is M pattern, this is a flagpole, and this is basically a breakout of this pennant. And we add the height of this flagpole, and actually that is a target. Okay. So those patterns are very easy. So here we don't see symmetrical triangle. We see flat top ascending triangle. And when you see flat top ascending triangle, you want the price to break from the upper part. If that doesn't happen, price can break out of a lower part. So this is good example of breakout of lower part with M pattern. So actually here you can see M pattern, and this is your breakout point. Okay, that is why I'm saying that W and M usually are neglected by traders, but they are really repeating a lot of time. They're always repeating on charts, so we can actually spot W and M with all those patterns which we will talk about. Usually when you see a form of triangle of a rooftop or a pennant or a wedge, especially if it's bearish, then you will also spot an M pattern. So this is M pattern because we see three important points, 1, 0.2, and 0.3. At the break, basically, of 0.2 here, okay, we are taking the trade. So we can take this trade, we can take a retest and continuation. Also, when you spot a flat top ascending triangle, you want to take a trade to the upside, not to the downside. Okay, so this is a filter. Okay, which time frame is reliable? You can take all those breakout patterns and those patterns in any single time frame, but the thing is, the higher the time frame, the more reliable the pattern is. Okay, this is a scholastic example of a flat bottom descending triangle. Okay, so flat bottom descending triangle, still M pattern here. Okay, see M pattern here, and you see how flat bottom triangle has responded. So when you see flat bottom triangle, you take trades to the downside. When you see flat top, you take trades to the upside. Okay. Carolyn is asking for a rooftop. I will show you later. Okay. So this is M, and M has been spotted in a flat bottom descending triangle, okay, here. So usually we take a breakout of 0.2 here, or we can wait for a retest. Actually, retest of M happened, okay, if this is 0.2, this is a retest here with a slight drawdown, then afterwards continuation. M pattern here again, okay, this is retest, continuation. So we can always find those M and W's, okay, you can see it here, W pattern, okay, so you take a trade here at this point, okay, this is 1, 2, 3 W, and you take the trade at the break of 0.2, okay. Okay, this is another example of a BPC pattern, how you trade actually breakouts of those patterns. So breakout, pullback, continuation trade, okay, here. You see how the bottom has been retested at this point. This is M pattern again. So this is your M pattern again within a rectangle, okay? So that is why I purposely didn't mention a W and M on a separate slide, because you can find these patterns really repeating a lot in Forex market. So this is W, okay, this is M, but this M pattern is actually put inside a rectangle, okay, this is rectangle. For a rectangle to be valid, you need to have two touches at least to the upper side and at least two symmetrical touches or near symmetrical touches to the downside, and then you can place it as a triangle. So this is actually a triangle, okay. Those are not very those are almost symmetrical tops, but because of that we have here almost symmetrical bottoms, and this is indeed a rectangle. And you see the reaction after rectangle breakout. There was a retest of these levels here, and then breakout to the downside. Okay, so this is a rectangle M pattern inside a rectangle. Okay, these are flags now. Okay, standard flags. Okay, this is a flag. Okay, so we have a pole, a flag, ascending flag, and actually ascending flags are bearish in its nature. Descending flags are bullish in its nature. Okay. This is when we hope for the price to go down after a bearish flag, but I usually do not take these flags a lot in a big consideration, because I always, when I spot, you know the logic, when I spot the downtrend, as in this example, this is downtrend, I look at this not as a flag, as a retracement. So this is just a retracement, so it doesn't have to use that fancy word bearish, bullish flag. This is actually retracement. How far retracement will go, we actually measure by applying Fibonacci and other confluence tools. So that is why you will not see me using these terms anymore. I use it back in past, but now the time has really worked well on my side, and I deserve and I respect what other analysts are telling and analyzing, but definitely I don't have any reason to use word of flag. Okay, this is retracement. So treat it as retracement. The only way basically how you can distinguish that, for example, if you want to take a breakout trade, then you just need to place a lower trend line here and take, as in this example. So this is a lower trend line here. Sorry, this is not very precise. This is lower trend line, and take, okay, this is retest. So just take a breakout retest. So you don't have to use the word flag, okay, it's retracement. Okay, this is retracement. This is retracement in downtrend. Prices has been making lower highs, lower lows with the occasional deeper retracement. So basically just a retracement. And this is a pennant here. Okay, this is the pole. This is the pennant. Okay, very good example of pennant. Okay, this is actually all slide, and there is a mistake here. This is a flag. It has been called a flag, and this is a retracement. to the, you'll see, breakout to the downside. This is another retracement and breakout to the downside. So actually all of these patterns are very similar in its nature. You can also here, you can spot M pattern again, okay? This is wedge, okay, one of the examples of a bullish wedge. Bullish wedge is always spotted when price is falling down. Bearish wedge is spotted when price is going to the upside. We will be looking at these patterns later on a live chart, and I will show you how to spot it very quickly, because I really, you will have an eye for this. You can spot a pattern in a matter of minutes, really, sometimes even faster. Okay, this is again a bearish wedge, so you can see this is actually W bullish pattern, see, W bullish pattern, and from this point it started to make a wedge. After breakout you can take the trade. Okay, so just watch how these W's and M's are repeating almost every time. So W and bearish wedge here. Okay, of course wedge reverses preceding trend, and after a breakout of lower part of the edge, we are expecting the price to go down. This is actual head and shoulders. We don't need to talk a lot about it. You know what head and shoulders is: left, head, right, and very often I tend to trade this at the top of the right shoulder, okay? Because very often, if there is a confluence, of course, if there is a confluence of price action factors, I tend to trade it at the top of the right shoulder, and actually I don't want to, I rarely take a trade at the neckline, just because very often it can happen that the price has already fallen to the downside and that we might be rejected. That is why when I see head and shoulders pattern, I often tend to trade at the top of the right shoulder. Okay, this is inverted head and shoulders, okay, inside a wedge. Okay, this is inside a wedge. So you can see it here, bullish wedge, price is falling down. It has formed a wedge, but here we have double confluence. We have a confluence of a bullish wedge here, okay, and we have a confluence with inverted head and shoulders. Okay, very easily spotted, inverted head and shoulders. Left head, right shoulder, okay, and it goes to the upside. Hook reversal top. This is hook reversal. Very often you will see how the price reverses, and the actual confirmation for a hook reversal is, you see the price has gone touching important resistance. Then usually this is called actually dark cloud pattern, and you see how the price is retracing. At this time the price has made basically a lower high here. This is actually a low here, but at this time this is lower high. So that is your signal for a possible to possibly look out for confluence for a short trade. Okay, so another one. This is not so easily spotted, especially if you're not trained, but you can see price is going to the upside, then it makes a sideways movement, and it makes a low. So this is a low compared to this high. Next time it should print a lower high. So this is a lower high compared to this high here. And actually then you're looking for a confluence to take a hook reversal top signal. Okay, so usually this kind of pattern we use with a confluence, not alone by itself, with a confluence. Hook reversal bottom, very similar to hook reversal top. You can see the price is falling down, then it makes a sideways movement here, and actually here you see how it repeats, but to the upside. This is a form of piercing line, and you see here this is dark cloud, and actually then the price will make basically another low here. Here is an actually this is a higher low compared to this low, so this is a higher low here, and from this time it break through this sideways movement and proceeded in trend direction. So this is how you spot hook reversal bottom. So trend to the downside, then daily, and then breakout, usually after a break of a higher low here. Goran is asking, do they appear on daily? Yes, you can see it also on daily chart. And of course, the higher the time frame, the more reliable. I don't usually go up above daily chart, so it's okay. This is 3 Buddha. This is 3 Buddha, what you asked me. But I want to tell you that this is actually this is a head and shoulders variant. That is why we call it 3 Buddha top, because you see there is usually a 3 touch here, 1, 2, 3, 1, 2, 3, and the price has made actually left head, right shoulder. So this is actually some form of, it's easier to call it 3 Buddha top, really, than head and shoulders than 3 Buddha top. Because when I say 3 Buddha top, I notice that traders have been confused. They do not, it's for some traders it's hard to comprehend. Why Buddha, why not head and shoulders? So that is why I have renamed it to head and shoulders variant. Yes, Kelly is saying it's fancier to call it Buddha, but you know, probably there are some traders who trade and they're they're Buddhist, right? And I don't want to offend anyone, and maybe some traders could be offended because you know, in Buddhist religion, Buddha is a saint, right? So basically, I don't want to offend anyone, and it's much better to call it head and shoulders variant. Although I didn't give this pattern a name, it's Bulkovsky pattern, 3 Buddha top, so I didn't give it a name. Okay, same one, 3 Buddha top or head and shoulders variant. Okay, look at this, irregular head. Yes, I didn't invent the term, but still, you see, there is a bit of similarity between head and shoulders and 3 Buddha top. Okay, see, this can be treated as a left shoulder. This is head, this is right shoulder, but this is irregular. You see irregularity. Okay. Ilya is saying fat boy variant. Cup with handle. This is cup with handle pattern. You know what cup with handle means. Okay, it's easily distinguished, cup and handle, because when you see this, you know that price tries to go upside, breaking the handle top. Okay, so actually you can spot it here. Breakout, pull back, continuation from this point. Okay, so this is a breakout, this is a pullback, and this is continuation. Adam and Adam, which also I removed from chart because this is very similar to W. The only difference is these two candles are almost similar. They have similar bottoms, and they have basically, this is basically a rejection from bottom. It's called Adam and Adam, but actually this is W. This is ascending scallop. The difference is that the ascending scallop does not show handle, which is indeed for right-handed person, Carol is saying. So you see, this is a candle, and this is without a handle. So this is ascending scallop. After you see this, you usually interpret it as a uptrend, and you want to buy into dips. So actually, you're not taking trades anywhere here. You're waiting for retracement to actually go with the trend. So this is actually a signal that the trend is changing. Okay, so trend is changing here, and you take a dip, then go into trend direction. Okay, if something is not clear, guys, do not hesitate to ask me. Okay, and I'm trying to show you how you can actually benefit from reading the charts. Okay. Okay. So ascending scallop is a sign that the price will turn to the upside. Okay. and this is a dip which you are looking for. Pull out Fibonacci after ascending scallop and wait for price confluence. Okay. We will talk about this also in detail on price action trading school. Darshan is saying this is a fantastic summary and webinar. Bravo, thank you. No, I will not cover harmonic patterns. Yes, crab, butterfly, bat, Gartley, those are sharp patterns, but those are harmonic patterns. And we don't have the time to cover harmonics. Maybe in some of our future webinars we will still cover it, but at this point we are talking about those standard candlestick patterns. Okay, this is another example of flat top ascending triangle, which is exactly a form of W here. Look, and the breakout of this top range. Okay, another example. This is a running pennant because we see a huge drop. So this is a pole. This is a pennant, a running pennant, because it doesn't have a vortex here. So when you see that it doesn't have a vortex, you still can treat it as a pennant, and it's called a running pennant. I think that I used the term in my yesterday New Zealand dollar analysis, which actually is rejecting as I predicted it from 64.10 to 64.30. So this is actually a running pennant. It still does not use vortex, and it's called running. Diving board, okay, same diving board, or V-shaped reversal. So actually this is V-shaped reversal. When you see V-shaped reversal, you actually want to take trades in you actually want to be prepared that the trend has changed. If you want to take any trades, you need to treat it as counter trend opportunities. Okay, counter trend opportunities, because V-shaped reversal is a strong buy into dip where the price is indeed reversing. Okay, so it's a strong buy into dip. It's called V-shaped reversal or diving board. Okay, after that you expect the price to make at least one more swing to the upside. And I will show you this how to spot a live chart. Actually, the easiest way to spot it on a live chart is to actually go to 4-hour time frame, because 4-hour time frame is a great compromise between intraday and intra-week swings. So what I do usually, I use a zoom out tool, and I tend to spot at now moment. Okay, Karen is saying kiss of death pattern. Maybe it's the term which a trader invent. I don't know about kiss of death pattern indeed. I'm not familiar to that. But this is how we do it. I just open 4-hour, let's say 4-hour time frame. You can spot it on every time frame. But usually, when you trade 15 minutes, you are trading indicator-based system, right? When you're trading 1 hour, it's okay. Well, you can have a lot of patterns. So my advice is either 1 hour or 4-hour for intraday trading. So this is easily, okay, you can see it here. This is now inverted head and shoulders. So this is a sign that USD/SWC can go up and the dollar might drop, but it's still in development from this stage. So that is why I'm saying, guys, sometimes try to trade those patterns from tops and bottoms. This is left shoulder, this is here, this is right shoulder. If you have taken the trade, here at this spot, you would be in profit. If you had taken trade here from the bottom of the right shoulder, you would have been in profit. So that is why I don't trade necklines anymore. I'm waiting for better risk to reward at the bottom, right? That is why I'm really eager to spot these patterns and trade it how I do it, not how old school has been teaching me. Indeed. So that is why I really prefer to take those trades in this direction. Okay, guys, let's make a quick 30-second break, and I will get back. I need to make a 30-second break. Oh, sorry guys, audio. I was muted. Okay, I will repeat it again. I will repeat it again. As Darshan was suggesting, GBP New Zealand. You see, this is M pattern. You always take trades on M only after 0.2 breaks. 1, 2, 3. So when 0.2 breaks to the downside, you can try to take the trade. Sometimes you will get faked, but you don't take trades on 4 hour. You take trades on lower time frames. That will be also a part of price action trading school. Okay. This is heavy, strong downside, heavy drop on GBP New Zealand. And actually, this is a good example because you can see here what we have been talking about. Okay, this is a form of a running, rising wedge. Okay, we don't see a vortex here, but we see that the price has been in a rising wedge and then it fell down. Okay, this is the level to possibly buy from. Okay, this is the zone to watch for. Okay, but this is a wedge, rising one. Okay, we can see, for example, it doesn't matter, those patterns are repeating on every single time frame. Okay, here guys, again, head and shoulders. You just need to zoom in and everything will be much easier for you. Okay, so actually this is head and shoulders. Okay, here left head, right shoulder. Taking a trade at the top of the right shoulder is much better than taking breakout retest at this point, just because you have bigger risk to reward. Okay, here at this point on. Okay, okay, let's see another one. Okay, inverted head and shoulders here. Inverted head and shoulders here. Okay, actually this can be treated like a left shoulder, left head, right shoulder, and you see what happened here. Okay, use the logic, the bottom of left shoulder and the bottom of right shoulder. Okay, the bottom of left, the bottom of right shoulder. Okay, let's use other one, and we are already over the time. So you just need to zoom out and try to spot some of those. Again, V-shaped reversal. Look, V-shaped reversal here. Okay. Okay, this is inverted head and shoulders. This is M. Look at the breakout of 0.2. M. 0.2 is always most important on M chart pattern here. Okay. Still, I did the live analysis on dollar yen a couple of days ago, and this is running pennant. This is bearish pattern on dollar yen, running pennant. Okay. Then we can also spot. Okay, here, guys. Okay, look at this. Okay, this is a compression triangle, and you look at the top what happened. It been broken, retested, and continuation. V-shaped reversal again. Running means when I use word running, that means that you don't have a vortex. Vortex is, this is vortex. The pinnacle of triangle, the pinnacle of chart pattern. It's called vortex. And here we don't see a vortex. We see that there is actually a running pattern. So it's without a vortex. That means it's in progress. Okay, I hope that this helped, guys. Please be patient for NFP. Tomorrow I will do NFP analysis, and wait for Monday. That is the time when we will have all those currencies reviewed. Okay, so thank you again for listening. Thank you for being here with me and with Chris. We will be talking with you soon, guys. Cheers and trade safe as always.